In previous recordings, we have talked about the requirement that financial statements should be able to be comparable, in that we compare financial statements between other companies, within the industry, and also within ourselves amongst different periods. Now, if we look at a detail level, one of the other areas that we want to be able to do a comparison is between revenues and expenses. As we mentioned in a prior video, that revenue recognition causes a problem if we're using the two different methods of cash versus accrual method of accounting. So when we look at expenses, we want to make sure that expenses are being recorded in the same period as the revenue. So we use the expense recognition principle, which basically tells us that we want to make sure that expenses are in the same period as revenues. Now that provides an issue for us if we're using the cash method of accounting. The cash method of accounting says that we recognize expenses at the time cash is paid. Now this can become a problem if you are buying inventory or supplies before you actually use or sell the items. Think about this. If I was to purchase a year's worth of inventory and I paid cash for it, I would have to recognize the inventory cost as an expense at the time that I purchased the inventory, even though I had been selling the inventory over the course of an entire year. So in other words, we would not be able to match the revenues and expenses in the same period. According to generally accepted accounting principles, we should be recognizing expenses when we incur the expense, which is normally at the same time that we recognize the revenue. So, generally accepted accounting principles requires us to use the accrual method of accounting when we recognize expenses. As this slide shows, is because of the time periods, we want to make sure that we are recognizing expenses at the same time as revenues. As we have mentioned before, readers of financial statements rely on the integrity of management as they create financial statements for the reader's review. The integrity is very important because we rely on the information being presented to make good decisions. Unfortunately, over the years, there have been many situations where management has distorted the financial information being provided to the readers by cooking the books. The term cooking the books implies the manipulation of accounting information by misusing the revenue recognition principle and the matching principle. By intentionally moving revenues and expenses into different accounting periods, management has the potential of distorting the financial information that it's being relied upon by the readers of the financial statements. This fraudulent activity could create a substantial loss by the readers of the financial statements due to making decisions on bad information. Here are two examples of companies that were caught cooking their books. The question is why does management perform such fraudulent acts? There are many other instances that you can find if you do a search on corporate fraud or business fraud on the internet. If you have an opportunity, take a look at some of the different cases that have occurred over the years. You might find it interesting to see how the various corporate frauds were initiated and how they were eventually caught by the various government regulators.